This seminar is a normal structured product seminar, except that we're going to do 2 products at the same time. And therefore, we might have to be a bit faster than normal. And like you always, if you have any queries, ask questions in the seminar or call us afterwards and we will go through things in more detail with you guys. The reason we have 2 at the moment is because the market is in a bit of flux right now. And there's 2 basic approaches that I think are probably going to be profitable going forward. And I'll explain why each of these products are suitable for one particular scenario. And maybe even both. I mean, there's no reason not to do both if you have the funds for it. But let's start, the normal introduction. And, by the time we get to the meat and potatoes of the stuff, I'm sure we'll have enough people coming in. Okay, doing 2 new structured products, ending September, so in about 2 weeks' time. As always, we are still Rand Swiss. These are us here. And we have basically relationships with a whole bunch of people. I don't know if you guys listened to me on 702 last night. I think I'll also do Business Day as well, last night as well. Those guys up here. I'm doing Newsroom Africa. Are we up here? No, not yet. Tomorrow. And I think I also might be doing Velocity next week. I'm not sure about that. I'll have to confirm it. But as you can see, we do a lot of stuff out there in terms of media. We're trying to do more just to get our name out there in the public. But we also do these seminars regularly to give clients and people that are looking to invest with us, so just general public, more information about the things that we are seeing out in the world. Not all of them are these kind of product, discussions. I do a weekly seminar or webinar rather on my thoughts for the week, a weekly wrap. It's on YouTube. You can just go look at Rand Swiss, search Rand Swiss on YouTube, and you'll find my seminars, Gary's, Christo's, Yaku's, quite a few things out there. And even Anthony Clark, who's very popular, analyst, especially in the small scale space in South Africa. So why you should listen to us? Basically, we are pretty respected, and you can see right now we were the stockbroker in 2019. We came out second in 2020. We came back again top stockbroker in 2021. So 2 out of the last 3 years, we were the #1 stockbroker in South Africa. The year that we weren't, we were second. We are the People's Choice Awards winner for the same 2019 and 2021. The new awards are basically announced, I think, in a month or so, in October. So we basically placed at the top or near the top for our particular categories in terms of this awards in South Africa for the last few years. And to give you an idea as to the comparison as to the kind of people that we're dealing with, we are up against the big banks, the Absas, the Standard Banks, and so on. That's the kind of competition we are beating to win these awards. Okay, so we do have some credibility in the industry if you're interested. And you can see that, here, Rand Swiss #1, Standard, PSG, blah, blah, blah. You can see the rest of the guys out there that we beat. And again, looking at, top tax-free savings account, the People's Choice Awards, which is important to us because we want people our clients basically decide whether or not they like us or not. We also placed among the online brokers and the advice-based brokers as well. I think one of the reasons that we may be not getting as high as in those levels is because we, of course, do have a more select client base. But that being said, the clients that we do have seem to like us quite a bit. Okay. After that little spiel about who we are and what we do, etc., let's talk about what we are talking about today, the meat and potatoes. Firstly, in this seminar, I'm going to look at the current economic environment. It's just what we think is happening right now. The next thing we're going to do is look at the 2 structures that we basically are trying to talk to you about today. Give you afterwards a little breakdown as to what we think each structure is most suited for. Now, look, we obviously have opinions about what's happening in the world. We don't always, need our clients to have the same exact opinions. Of course, if you look at historically, very few clients ever beat us overall, especially over the longer term. The vast majority of them would have been better off just following our advice exactly. But some of them do have different opinions, and some of them do have different, risk profiles. And a risk profile is a weird thing. It's just because a thing ended up being in one way or another doesn't mean it's a bad idea to get or to adjust for that risk. The example I give is car insurance. If you live to basically 70 and never have an accident, technically paying for car insurance for like 50 years was probably a bad idea financially. But in reality, it wasn't a bad idea, because you could not know in advance what was going to happen. Okay, so in terms of, so what I'm basically saying is the clients that do beat us are lucky, smarter, but, jokes aside, we do have certain, understanding of what's happening in the future. Obviously, we can never be correct entirely. No one can. But looking at what information we have right now, we can make some predictions as to what's going to be happening in the future. Our predictions are based on opinion, based on some of the things we know, based on some of the calculations and assumptions we push forward. You may have slightly different calculation assumptions. You may have a slightly different risk tolerance, and that might make a difference as to what you want to invest in or not. Okay. So when we discuss what's best for you, it's not going to be the same thing that's best for everybody. People have different preferences. People have different risk profiles. People have different assumptions about the future and things that they want to protect against. And then finally, we do a Q&A, and then, we'll just go through a little global managed portfolio, look at that. I think Gary might be back in time for that. If not, I'll go through it with you guys, and a Q&A on that as well. Okay, so nice little quote from Malcolm X. The future belongs to those who prepare for it today. And that's what we need to understand. We're going through a very turbulent time. It's obvious. I just had a nice little private meeting with some analysts, and we were talking about the food situation in South Africa, and things are turning bad. He was discussing the fact that people are switching away from chicken to bologna because things are really difficult at the moment in South Africa. He's talking about the fact that we are seeing fertilizer prices, which is a big input into the cost of food, likely to remain high for years, quite frankly. And we have all these different factors out there in the world that making this time, this particular period in history, one of the more eventful periods in history. And as the Chinese say, a curse is may you live in interesting times. We are turning to be quite interesting times. I mean, think about it. It's quite, in fact, it's almost certain that in say 20, 30 years time, 50 years time, people look back at this period of about 2016 to even 2025, really longer than that, as being a quite interesting time in terms of human history. There's periods in human history that are very boring. You're talking about the early 90s to the global financial crisis, very boring. Hardly anything happened. 2010 to about 2016, 2017, until the election of Donald Trump, hardly anything happened in the world. There are these periods of quiet and not big events, and there are periods where a lot of stuff happens very quickly. Okay, as the saying goes, there are decades when nothing happens, and there are weeks when decades happen. Okay, and we are living through one of those. I think those years, all this period of time where a whole bunch of events are happening at the same time. So, what does the current economic environment look like? Well, in terms of what we're looking at right now, we are seeing inflation really coming out as a big issue. We all know oil prices have gone up and come down a little bit, but they're still quite a bit higher than they were. What's happened is we have seen inflation really kind of spread out into different sectors in the economy. Just recently, yesterday, we had, the day before yesterday, I believe it was, yes, the day before yesterday, we had US inflation numbers come out. Those were pretty high. They were about 8.3%. Now, why were they high? It was not because of petrol. It was not because of gasoline. It was because of the stuff around the rest of the economy. So petrol and gasoline may have been the trigger, may have been the spark that got us to where we are right now. But we are seeing enough evidence that inflation is really spreading in the economy. Okay, housing prices in the US are quite high. Rental prices in the US are quite high. Globally, we're seeing food prices, really tick up. Like I said, food is one of the big concerns. If you follow any of my, articles or any of the seminars I do, I've been talking about the food situation since basically the invasion, like March this year. It became very clear within a few weeks that what's happening in Russia and the Ukraine is going to have a huge impact globally, and not just in terms of financial markets. By some estimates, it's very likely that more people will die of the after effects and the surrounding effects of the of the Russian invasion of Ukraine in the rest of the world than will actually die in Russia and the Ukraine. We're talking about food prices increasing substantially in places of the world that cannot afford to have higher food prices. Okay, and that's obviously about humanitarian. But what's also happening is that we are seeing a disruption in the global economy. Any disruption that occurs causes uncertainty, and uncertainty tends to result in inflation. If you don't know what the future is going to hold, you want to basically have a bit of a buffer against the future. You want to have higher prices in the future for your goods or your services. your labor, etc. And that builds an inflation system. If you had certainty about the future, you're much less likely to demand these higher prices. Now, if inflation really starts getting to a big issue, we'll talk about in a second, there's going to be knock-on effects. And one of the ways in which basically, and these knock-on effects can be very, very detrimental to the future health of an economy. So central banks have come up with a plan over the last few decades that whenever inflation gets very high, what they do is they crack it down. When they crack it down, as hard as they need to crack it down, because the benefit of having low inflation, low uncertainty in the economy is quite large. So even if there's short-term pain, because the way you crack down on inflation is by raising interest rates. You raise interest rates, that creates economic growth. Economic growth goes down, inflation goes down because people can't afford to buy stuff. That's pretty much how central banks around the world work. The reason that they're willing to do that is that they believe, and evidence has shown, quite frankly, that if you're willing to do that and then say a year, 2 years, maybe 3 years of pretty bad economic conditions, you could result in decades of good economic conditions. The example would be Paul Volcker. Paul Volcker, basically in the early 1980s, late 1970s, came out and basically put the US economy into recession. He broke the back of inflation. We had inflation drop, from like the high 20s, effectively down to, below 5%. Also the high teens, sorry, to below 5%. And what happened was that you saw decades, literally decades afterwards, that inflation was never a problem in the US again. So we're talking about almost 40 years that inflation basically disappeared as a problem for the US. Why? Because the central bank showed that they were willing to fight inflation irrespective of the cost. He pushed interest rates to 20%. That is something that obviously pushed that economy into recession. It did it twice, caused high unemployment for a brief period of time, and resulted in multiple decades thereafter of growth. This is the lesson central banks have learned. And when they see inflation rise, that's the kind of thing they're going to be doing again. Rising inflation results in higher interest rates, low economic growth. The next thing we're going to discuss is also global insecurity. It's not just Russia and the Ukraine. There's a couple really troublesome issues around the world. Firstly, of course, on the African continent, food issues tend to result in higher instability. Even before we had instability in food at the moment, we had issues in Ethiopia, which is one of the largest economies in Africa. Nigeria still has its own troubles. We've seen, for instance, Ghana go to the IMF and ask for money. Globally, we've seen places like Sri Lanka also do the same thing, have a collapse in their economy. Before a massive, unprecedented level of flooding, Pakistan also had issues. Now they have worse issues because of the flooding. Bangladesh, etc. Peru, Argentina, Turkey all have these very difficult issues. That's just on the financial side. On the security side, we have, of course, China possibly invading Taiwan. There's a lot of saber rattling there. These issues, could really, really impact the global economy. And finally, longer-term issues. I mean, we look at demographic, changes globally. It's quite likely within our lifetimes, next 30 to 40 years, we could see the population of China halving because of demographic issues. It's happening in Europe. It's happening in a lot of parts of the world. And these obviously are creating, instability, creating, an uncertain future for us. For a long period of time, since the end of World War II, from 1945 till about now, so we're talking about a period of about 75, 80 years almost, we've seen basically the global situation have a certain trajectory, higher population growth rates, more freedoms. The path of humanity was tending towards progress, or the out of humanity was tending towards progress. It's quite possible we are seeing changes in that going forward. More, authoritarian regimes, more surveillance, more conflict. We're seeing basically more insulation. Now, I'm not saying this we are right now at a point or the worst point we've been in the last 70 years. I'm just saying in the last 70 years, we've had a trend where things were getting lower. So you had less conflict, you had less, barriers to trade, you had less instability worldwide. These started at a very high level in World War II. But over time, the 60s were better than the 50s, the 70s were better than the 60s, 80s better than the 70s, etc., on a global scale. Like the 2000s, the 2010s were the best period in human history, in terms of the number of people being wealthy, the number of people being safe, blah, blah, blah. That may be a trend that might be reversing. But of course, that's something we discuss later. So let's start off. Inflation. Here is the inflation number for South Africa. You can see basically we started well below 5% a few years ago, 2021. We've got to just under 6% by 2022, after this year. But in the last 3 months or so, we have just seen a skyrocketing inflation rate, 7 to 6.5%, 7.5%, almost 8% right now, and it's probably heading higher. Like I mentioned, we might have a bit of relief coming through with regards to petrol prices, but other things are really, really not working in our favor. So inflation in South Africa, an issue. In the US, inflation higher than where we are right now. Remember that, we're only like under 8% here. Inflation in the US is basically at 8.3 and they peaked at 9.1, but it's heading down. But it's not heading down as quickly as they had hoped for. And what you must understand is that our inflation targeting up here, until we breach 7, we are still basically, 6, we're still basically in our range, acceptable range, with 3 to 6% inflation. And if we breach 6 here, we don't want it to be above 6 for too long, but 6% is the upper limit effectively. In the US, their target number is 2. So if you had to compare it to us, if our target number was like, coupled to the US's in terms of the break between inflation and the target, our inflation rate would be something like about 18, 20, 25%, okay? That kind of number. So that's what a 8% in the US is. It's like a 20% in South Africa in terms of inflation, because their target, their expected inflation is so low, okay? And then the EU keeps on heading higher. There is been no peak at the EU at the moment. Their last number was 9.8%. Places like the UK have reached 10 and come down slightly. Other places are going even higher. We are seeing quite a lot of fear around what's going to happen in December, January, February, until about March next year, which is the winter period in the European Union. It's a very, very difficult period for them because they are going to, likely very difficult period for them because they are going to be facing very high heating costs. And the EU is an incredibly cold place in winter. Not as quite as cold as you would expect, considering how high up they are, but still pretty cold. I mean, you're not going to survive the EU winter just with a blanket, a jacket. You need heating. In South Africa, our coldest days, have a blanket, have a jacket. It's not comfortable, but you're not going to die at night, especially indoors. That's not the same case in the EU. And that means that people are going to be facing really, really tough situation when it comes to what's happening in terms of the price they pay for gas, or natural gas, but also in terms of the impact it can have on the population. Very poor people in the country, in these countries, are going to experience a very tough period because of inflation. So what does it all mean? Well, inflation right now, especially in the developed world, has gone not just above what the expected level is. We're not just beating it by like a couple percent. We're beating it multiple times what the acceptable level is. So that inflation rate is, by all terms, under control. What is the problem with that? The problem is as follows. The way central banks work with inflation is they set what's called inflation expectations. That is why it's important for them, whenever inflation gets out of control, to come and hit the economy like a hammer, cause a recession if they have to, cause high unemployment, to bring inflation under control. Because what they really are trying to do is to make sure that if you ask somebody in the street, what do you think the inflation rate over the next 10 years is going to be? They're going to give a number pretty close to the target level. Why? Because if you expect inflation to be 20% year on year, you're going to ask for a 20% wage increase as a worker. As a business owner, you're going to set prices 20% higher every year because you basically got to make up for the fact that your costs are going to go higher. Okay. Once inflation expectations get to a certain level, they kind of become a self-fulfilling prophecy, because what happens is, by having a high expectation, you demand higher prices, demand high price for your services, your goods, your labor, whatever it may be. That kind of causes prices to rise, because it's self-fulfilling prophecy. The way you get out of that is to make sure that every time you think inflation is high right now, you know that the central banks will come in and make sure the inflation drops down. So you don't build in these high inflation expectations. Even though inflation today might be 10%, there's no way the central bank is going to be 10% for the next 10 years. No, they'll bring it down back to 2%. And therefore, you can set your inflation expectation as 2 or 3%, because that's what you expect it to happen. Every time something goes bad, the central bank comes in and does something about it. Now, what would happen if the central bank didn't do something about it? Inflation goes to 10% and the central bank does not do something about it, does not come down and take action that brings it down. How long before you stop believing that inflation over the next 10 years is going to be back to the historical norms? That is the situation we're in right now. In the EU, the US, inflation has broken out of levels. We're talking 3 times at least what they find to be acceptable levels of inflation. They are currently trying to basically race against people's expectations to get inflation under control before what we see start happening, or what we expect to start happening is before people in those countries start expecting inflation next year to be 6-7%. As soon as an American or a European, or the average American or European, starts expecting current inflation rates to be reflective of future inflation rates, when they expect the future inflation rate to be 7 or 8%, what's going to happen is that's going to make almost a self-fulfilling prophecy. And now you've got to go in and really punch the economy down and make sure inflation comes down as soon as possible, because you've got to break that expectation among your people. So that's what they try to do right now. And what that does for us is that it increases interest rates globally. And as interest rates increase globally, you tend to find emerging markets like us in South Africa under pressure. The currency in South Africa has, you can see, obviously excluding that COVID spike, in the early 2000s, early 2020, sorry, really, been, like I said, a huge issue. Okay, obviously we also had, issue of load shedding and so on along the way. But, accepting these kind of crazy numbers we saw like a couple of years ago, we are basically in a situation where we've kind of followed a certain path, of about 6% or so weakening over time in terms of our currency. The rand, when things are normal, weakens by a little bit every year. When things are crazy, when there's load shedding, or when there's a COVID situation, or when there's a crisis, like, for instance, at the start of this year, we saw the Russia situation occur. What tends to happen is you tend to find more and more instability coming through with regards to the global environment. You tend to find emerging currencies like us in South Africa weakening. The only situation you have historically when the dollar weakens and, like, South Africa or other emerging markets strengthen in terms of their currencies is when there's a period of prolonged instability, or prolonged stability. When things are very stable, very easy, what happens is people are looking for any kind of growth they can get, and therefore they have to go to the emerging markets. When things are nervous, you don't want to be risking your money in an emerging market. You want to make your money to the safest place in the world, which is the dollar. Things have been nervous. Therefore, we are finding the currency weakening, probably at a level that's going to be above trend, and maybe prone to spikes like we saw in 2020, with COVID. So that is the currency. So what does that all mean for you? It means you're living in an environment where if you just hold on to cash, your money is weakening basically 7-8% a year. Okay. That means if you had like $1 million, in 10 years' time, it's going to be worth less than $500,000 in real terms. Okay. The next thing is that it's not just a South African phenomenon, it's a global phenomenon. You're not going to find like these little safe havens like you did in the past. Where South Africa had an issue, you can just go put your money in some safe haven out there and ignore it. No matter where you invest in the world right now, you're experiencing the same kind of uncertainty. Some places worse, some places will be better, but everybody is being affected by it. Like the EU, the US. And the next bit is that we are seeing a currency that's maybe a little above trend in terms of how weak it is right now, but prone to further weakening if things happen. But again, if you look back at say 2008, after 2008, if things calmed down, the rand got a lot stronger, a lot quicker than you would expect. So we can't always say for certain what's going to happen with the currency. Okay, so what does that mean for our investments? Let's look at each of these investments in particular, see what the pros and cons are, and then decide which is better for you or not. Okay, the first investment you're talking about is a dividend structure and has the following payout profile. First of all, it's a local stock. It's held in a local stock account, so you don't take your money and convert it to dollars. Okay, why is that important? Maybe you don't have the ability at the moment to do a dollar transfer. maybe you don't have or you have a fear of what's going to happen internationally in terms of just having everything in dollars in case the dollar strengthens or weakens, speaking which your fear comes from. So it's a much simpler structure. It's much easier for you to basically invest in this because the money's still in South Africa. You don't take an offshore transfer. You don't have to worry about taking money out of the country. You don't have to worry about using your allowances or anything else. It's a 3.5-year structure. So this is a short structure. So it's not tying your money up forever. It's tying it up for 3.5 years. Why is that important? Well, you really want to get about 3 years. It's not a negative to get beyond 3 years because beyond 3 years, you can claim capital gains much easier than if it's below 3 years in terms of an investment horizon. After 3 years, it's much easier for you to take capital gains. Why is that important? Capital gains means you pay capital gains tax, not income tax. And that really improves your investment. But the highest taxpayer out there, the guy that's making basically, like a 1.5 million above, let's just say he makes R1 million in gains from an investment. Under capital gains, he's going to pay basically a fraction, 18% of his money away. So R1 million gets 820,000 as a profit after tax. If this comes through as income, he'll pay 45%. So instead of getting 820,000, he'll get 550,000 as a profit on the same R1 million gain. So you want to be above the 3.5 years, not a negative. It's pretty much the shortest you can have to the capital gain, benefit. There's a 100% RON guarantee. Why is this important? I know the RON is weak right now, but it's weaker than it should be according to historic trends. Okay, so it could easily come stronger. 15 could be a level that we hit again. Having a RON guarantee means that you have some kind of insulation against currency fluctuation. Okay, and for a 3.5-year period, the short period, yes, you are losing some due to inflation, but it's not as much as it'd be for instance a 5 or 6 year structure. So you are getting that benefit of having a smaller period, making sure that that guarantee is stronger. And it's 100% guarantee. It doesn't mean what happens to the world if we have a massive pullback, like we had in 2008 or even worse maybe, you still get your money back in RONs. So that gives you some protection against the worst of the worst case. The next thing it does is it gives you a 2 times return on the global dividend index in dollars, which means what? It means the following. It means that, let's just say the global index went up by 10%. You would get, let's just say you put R1 million now in the conversion rate that's now worth basically $100,000, $100,000 investment, right? The R1 million you put in. I think that's 10%. You take that 10% of 100,000, that is $10,000, and you convert that back to rounds. You get twice that as your return. So your guarantee is in rounds, but your returns are linked to the US dollars or rand rate. So you get a bit of both. So you're not taking a very strong opinion on saying the rand's going to get weaker or stronger. If the rand gets weaker, you benefit from the return. The rand gets stronger, at least your rand guarantee looks a lot better. So you have a bit of both. And the minimum for this thing is just 50,000 rands. Okay. So very simple structure, guarantee in rands, upside in US dollars that eventually gets converted back to rands, 2 times the return on an index. Okay, we'll talk about the index right now. And you have unlimited upside. Okay. Let's have a look at what this thing looks like in terms of the index. So this is the MSCI World. This is the light gray one. This is the Global Dividend Select Index, which is the most darker one. Why is this important? Well, this is just for the last couple of years, but you see how the dividend one has outperformed the overall one? The reason is that companies that pay dividends tend to be more stable. They tend to have a more established, mature business. They tend to have nice free cash flows. They tend to be businesses that go through uncertainty better. If we are living through a point of high uncertainty, we're going to expect the dividend index to do better than the overall market index. Okay, dividend indices tend to underperform over time. Okay, because there's more stability there, and growth, basically tends to outperform value. But If you're in a period of uncertainty, you want to be in a dividend index, number one. Number two, what we're doing is we're getting double the return on the dividend index. So even if there's a bit of underperformance, if you double return, it pretty much comes back to the same return as you would expect the overall index. So you have an outperforming index, but because we're doubling it, giving you the same, at least the outperformance in uncertainties, but giving the same average overall rate over time. So you're getting all the benefits and the costs. And remember, worst case scenario, if things turn negative of 3.5 years, you get your money back. This is what this particular index looks like. You can see right now that it's pretty nicely spread between the whole world. So it has the US, okay, up here, the dark one. There's Japan, it has France, it has Canada, Germany, Australia, Hong Kong, Britain, Singapore, Italy. These are the big components here. Basically, all first world countries. Not just first world countries that are really embedded in the current global security system. Japan, France, Canada, Germany, Australia, Britain, Singapore, Britain and Italy. So Singapore and Hong Kong are a little bit different, but those countries basically are part of a national alliance in terms of military with the US. They're part of the strongest, military alliance in the world. So if there is a period of uncertainty, these places are going to be fine. Hong Kong, there are some issues, but Hong Kong is basically the part of the second, strongest thing out there, which is China. And Singapore, which is the one risky a little bit out there, but it's one of the smaller pieces as well, which are like 4% or so. But looking at this particular thing here, what you're seeing is that in terms of what the geographic allocation is, this is pretty safe, or as safe as you can be in the current world environment. The next thing, what is it invested in? It's a split of everything. You have financials, you have resources, you have basically utilities, you have banks, you have healthcare, retail, basically all the normal stuff. The one thing that's underrepresented here is tech, okay? Because tech tends not to be high dividend paying companies. And this is what the payoff profile looks like. Any negative performance on a global select dividend 100, your money back 100%. Could be down 50%, could be down 70, 80, 100%, you get your money back. Quite frankly, I think more than like a 70% or 60% guarantee, not really important, because the market falls 60%, 50%. We're in a situation that's as bad, if not worse, than the global financial crisis, at which point, as you know, in the global financial crisis, really strong financial institutions went under. That's the kind of situation we'd be seeing. There's about 70 or 80% fall in stock markets. The only thing that causes that is massive instability, and you don't know who your counterparty and your risk is going to be like. But the good thing about this is the upside. If, for instance, we have a rebound like we had in 2020 or 2008 or 2002, what we expected the last couple of decades is whenever there's a massive fall, like 3-4 years later, the rebound has been incredibly strong. Why? Because central banks around the world tend to get together, they start decreasing interest rates to try and boost economic growth, and that causes stock prices to go high. Now, if this is a positive scenario, what you really want is high levels of potential growth. Nothing is better than a multiple on the underlying return, unlimited. And that's what we have here. We have unlimited growth in US dollars on the underlying index, okay, times 2. At the same time, if you're wrong, and you could be wrong, if you think things are very uncertain, quite likely you're wrong, you get your money back in rounds, okay? So that's the big positive here. Unlimited upside, total guarantee in your market, and a split between rand and dollar, which gives you a bit of each, which makes it less likely that you're going to be suffering, for instance, if the rand goes to like say 11 or the rand goes to 30. Okay, now here's the next structure. It's the auto call. Now let me explain to you what an auto call is. An auto call structure, what it does is before it ends, let's just say it's a 5-year auto call, like this is a 5-year auto call. There are certain anniversary dates in this auto call. Every time there's an anniversary date, what happens is a certain set of conditions must be met. If they are met, the structure closes and you get paid out a certain fixed fee. Okay. If it's not met at any time or not met in a certain period, next period, next period, next period. Okay. Until the end time, in which there's a final calculation done and your final payout is given to you. Now, with this auto call we have, your works is this. It's a 5-year auto call. It means you have 5 years to get paid, but it doesn't mean your money's gonna be stuck there for 5 years. It's quite possible you get paid out within 1 year. But you have up to 5 years for the conditions to be met. Now, that is good. Can you imagine basically having a lotto, and then you basically have more and more chances to win the lotto? That's very positive in terms of your potential return. Okay, having a 5-year period here is very positive because it gives you more time in case things don't go in your favor for you to benefit. Okay, it's callable twice a year. That means you have more times that you can actually win as well. Not only is it for a long period, 5 years, you have more than one time in any year, except for the first year, up until the second, where you will be paid out. That's important because again, imagine if you basically can go and make a bet on something. The more times you can check that bet, more times you can basically win, the better it is for you. So something that's callable twice a year gives you twice as many chances to basically win as if something is callable once a year. Okay. The next thing is that the first year you don't get a call. Again, good thing. Why? Because quite frankly, if you call in the first year, you probably get kicked out after 6 months. Now, after all the time and effort you put into something, you really want to walk away from your investment with, like, say, a 5% or 6% total return. Not really worth it. Okay, you want to at least pack in like a full year of return before they start potentially kicking out of this investment. That gives you more of a reasonable return in terms of the effort you put in. The costs are not going to be too hectic, but I mean, you spent effort, you made a decision here. You want to get at least 1 year of this good return. Okay. Next, this is based on 3 indices that we think are good. One in the US, the Nasdaq, one in Europe, the Euro stocks, and one in basically third largest economy in the world, the Nikkei. Why do we like these countries? Well, often these auto calls, especially words of auto calls, they'll give you something like this. They'll give you the S&P 500, the Euro stocks. They'll give you Brazil, or they'll give you basically Spain, or they'll give you some small index like India's. Who knows? It's like saying, okay, imagine having a chain bet. Where you say, okay, this must win, that must win, and that must win. And 2 of them are good bets, and one is the long shot. The long shot makes the whole chain basically weak. Here, each of the things we're looking at are some of the major indices in different parts of the world. The Nasdaq is one of the major indices in the US. Euro stocks is the major index in Europe. Okay, the Nikkei is the major index in the EU. In Japan. So all links of this chain are strong. Big economies, big histories, big capitalization. Okay. Sorry about this. This is incorrect. This should not be offers of 4%, but it should be offering a 14% per annum minimum in US dollars. Okay. We are looking at an investment here, okay, that's based on the worst of 3 really strong indices, really strong, really big indices. And if none of them are negative, then you have the core periods. Okay, there's 9 of these core periods. You will get a 14% return, not a 4%. There's one that's in this area. At least 14%. In fact, our latest calculation is more than 15%. But we won't do this trade unless it's at least 14%, sorry. So you're getting a 14% return. And why is that important? Go back here. Well, this is a dollar return, 14%. What's the EU doing? Doing 10. What's the US doing? An 8% inflation rate. That means 14%, right, is easily beating inflation and a bit more. It's a strong real return, well above the worst inflation we've seen at the moment. Okay, and it's a dollar-based return. And the US already, the US inflation rate is falling already. Okay, so this is going to give you a strong US-based return. We are saying not 4%, it's 14%, yeah. But it is going to be a minimum. Very likely we'll be seeing more than 14%. I can't promise you what, but I can guarantee we won't do it unless it's at least 14%. Right now, like I said, if we do a trade right now, at the current point in time, last time I checked, it was over 15%, 15.1 or 15.2. It could easily be over 16 by the time we do the trade, but it will not be below 14. So think of 14 as a minimum, and if it comes to 16 or 17, it's a nice positive surprise in your favor. Okay. It has USD capital protection. It's a 5-year time horizon. At the end of 5 years, if the market, the worst market here is not down more than 35%, you are going to get your money back in US dollars. Now, over time, US dollar does weaken, but historically, it's a lot stronger than the rand. So even though the other one has a guarantee in rands, this has a guarantee in US dollars. Okay. Yeah. The 15% per annum in the Zoom invite is what the current market looks like. But what we will say to you is this, that we won't trade unless it's at least 14%. So the current market is 15%, but we won't trade unless it's at least 14%. Because market fluctuates. You know, the market right now won't be the market in, like, say, 2 weeks' time. It's above 15%, right, in the current environment. But we have the actually a minimum, like, we can say, okay, if it's like 14%, we won't trade. Okay, so that is the answer that, Gavin. It will be at least 14%, okay, but for 14. Right now, the market says 15, but we can't guarantee that's going to be the case. And we don't want to basically be sitting around, you know, not doing a trade just because it's 1% away from, you know, what the current market is. If it's like 2-3%, yeah, we can make an argument for that, but, you know, 1% won't. Okay. As US capital protection, like I said. Now, this is a cool thing, which you guys may not know. This is going to be held in a Swiss bank account. We're going to create this for you. It's a proper Swiss bank account. Okay, if you wanted to have, you know, other things in there, is the tax return taxable as income or capital gains. Look, we can't give tax advice, but what we can say is that previous ones of these have been come through as capital gains. Okay, or previous you know, investors have claimed capital gains. We can't give you tax advice. Who knows what the government's going to treat things in the future? Who knows how they change things? But, you know, for the both of these things, you're basically clients have claimed capital gains in the past. The reason is, yeah, because it's a 5-year period for this, and there's a possibility of you losing money. Okay, because there's obviously not an unlimited guarantee. So, you know, you are risking your capital in this particular environment, and you're looking for a period of about 5 years as a maximum. Get paid it earlier, not your wish. But again, we can't give tax advice. But looking at the Swiss account here, what's important to understand about this is, is that we're going to create a Swiss bank account for you. Everyone that does the structure, if you don't have one already, a lot of you guys do have the Swiss bank accounts, we're going to create a new one for you. Actual Swiss bank account, which if you wanted to, could come along with a debit card. You could pay a fee for that. It's a couple of grand a year, it's like $100 a month, you know, not totally out of like sync with what we in South Africa experience as bank charges. But for the Swiss bank card, you can take this card and buy stuff in Australia or buy stuff in Switzerland at a boutique or whatever you want to do, you know, buy a burger in like London or whatever. So it's a proper bank account. I strongly advise, you know, most clients that can afford it to have one of these accounts. Why? Because it's based in one of the strongest systems in the world that we as South Africans can have access to. Now, it's not as strong as the US system, of course, but the US system is impossible for us to get access to because the US has their own crazy tax rate where they have these residence-based, also citizenship-based taxation. And once you get into the US tax system, it becomes a nightmare, okay? The example I'll give you is the reason that we had FIFA under investigation by the FBI is because they use US, you know, financial entities, and that kind of gave them a whole exposure to the US system. You really don't want to be investing via a US bank or a US institution directly, because it's going to give you a lot of issues with regards to taxation, with regards to regulation. It's a nightmare. The best place really for a South African to invest in is in Europe, preferably in Northern Europe. Okay, Switzerland is up there. Okay, the reason I say Northern Europe is because we've had issues in places like Spain, there's issues like places like Greece, especially in places like Cyprus. Okay, the one thing I'd say to you is this: the Swiss financial system functioned perfectly well through World War II, right next to Germany, right in the middle of a world war. Their system held up. You can't say the same for places like Singapore or Mauritius or Panama or the Bahamas or whatnot. They have not really been stress tested to this level. So if you want to have an account in something that's really, really safe, the Swiss account is there. You do this investment with us, we open the Swiss account for you. You can put more money in the future into that account. The account doesn't disappear when this thing ends. You can keep that account forever. As long as you wouldn't just pay the minimum fees, like I said, it's a couple, grand a year in terms of charges for keeping the stuff open. You have it open. It's like a normal bank account. Like having an Absa account. You're not going to have an Absa account for free. There's a couple $100 a year you pay. The same thing here. A couple $100 a month you pay. Same thing. A couple $100 a month you pay. You have that account open. What's special about a Swiss bank account is this: that it's not just a bank account. It's also a stockbroker account. You can go buy shares in that account. You can go buy ETFs. You can go buy gold. You can buy Bitcoin if you wanted to in this particular account. It's a very, very flexible, very, very strong account. And once you have this open, all this available to you as well. Future structures you want to do, that account's already open. Once cash in there, you can just easily do a transaction to do it. Structures with other people out there that you might find on the internet or might be interested in. Again, account open, do what you want to do with it. Okay. So this is a big advantage of having this particular thing here. Because what we're doing right now is we're offering you to open this account for a minimum of 250,000 rands, which is the smaller amount than we normally charge you guys for having a Swiss account. Why? Because it's a bit of a headache for us to basically go and just open this account for a normal investment. But because we're doing a structure here, kind of makes financial sense for us to do it. So you're getting access to this account at probably like half normal minimum price that you'd have access to the account at. You basically, once this is open, you can put as much as you want to in there. You can put, 10 million, 20 million, whatever you want to do with it afterwards. Or you can keep this thing at the current level if you want to, just as long as you wouldn't pay the monthly fee. Okay. So in terms of investing in this particular structure, what you're dealing with right now is access to international, like financial institution, access to an international account. It does come along with more limitations in terms of just the pure, the pure admin involved initially. But we've got our guys trained up. We are ready to go in terms of opening these accounts up, and we will make sure your accounts are open, unless you are a international drug dealer or a son of a financial, or sorry, a politically exposed person, like maybe some reports or something, that might be a bit difficult. And if you're a normal individual that's followed the law and you have like a reasonable thing, you can get your account open. And the account is yours. Okay, really big advantage of this particular investment. So, in terms of the Euro stocks, right? Just want to show you what these indices look like. It's pretty much stable. Okay, had a drop in 2020, like you see here. Went down to 25.48. Currently 35 some change. Okay, that is a pretty big drop, but we aren't at a level that's as high even as the market was before the little thing. So if you ignore this here, this is a pretty cheap level, I think, to get access to the Euro stocks. Let's look at the NASDAQ. The NASDAQ is a little different. There's a drop. It's at 30, basically. It's about 699, so 7,000 here. Okay. Currently, it's about 12,000. So it's come up quite nicely. But the high here, okay, is not 16,000 some change. So it's really, really off its highs. So you're still getting something that, even though it's up above where it was in 2020, it's way, way off its highs. And here's the Nikkei. Again, the low here was 16,500. Currently sitting at 28,000 or so. The high here was 30,000. So it's above the low of the year. But if you look at this point here, it's pretty much a reasonable level above where it was just before the crash. And Japan was really not affected by the COVID situation, quite frankly. They got through it better than most places in the world. Very low death rates, maybe it's the masking, whatever it may be. But again, you can see this is a pretty stable index. Okay, so look, it's a pretty stable index, all of which are well below their highs. The Nikkei is about, say, 7% below its all-time high. Its high recent high. There was a period in the early 1990s, which is decades ago, that was really a bubble. But since then, it's been pretty stable. Nasdaq has done strongly, but we're getting it significantly below highs, and we're also getting the Euro stocks below highs as well. Why is that important? Because if you look at the guarantee we're giving you here, we're giving you a 35% guarantee, but this 35% after a fall. Now, you look back in 2008, we had markets falling 40% on the highs. 40% is obviously more than 35%. But some of the falls really happened. So that's a big positive. The next thing you look at here is that these things rebound from crisis quite quickly. Look at that. Doof, 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 up, right? If there is any kind of stimulus into the economy again, any kind of like positivity into the economy again, you're going to find these indices getting through, that negativity quite quickly because the central bank is quite strong. And then all we need to have happen is we need to have basically you getting back to flat, and you get paid out your return. A return, like I said, a minimum of 14%. Now, right now the market is 15. A minimum of 14%. Well above whatever the inflation forecasts are right now for like the US dollar. Okay, so this is what the payoff profile looks like. The first observation happens basically at the end of the first year. So the first year is no observation, and the first year says all the underlying is basically above or below, so it's everything positive. Okay, even the lowest one is just 0.1% up or just flat. You get your money back, and then you get a coupon for each period that's elapsed up to 14%. A minimum per year, so you get like roughly 7% a year, per quarter, per half year. Okay, well above the inflation rate, the US dollar. This happens basically all the way from the start of the first year till the end of the fifth year. So you have 8 periods where you have that decision made. In the last period, the ninth one, what happens was you do the same test. If you get the same test done, you get basically your money plus all those coupons returned. Okay, so if it's after basically 5 years, you'll get like a 70% return in US dollars, or maybe an 80% depending on what the market looks like at the moment. But we're looking at 5 times, the annual return. So 5 times 14 will be 70% US dollar return. That's in 5 years' time, which is not bad at all. Okay, especially when you consider the fact that we're giving you this return with a capital guarantee associated with it. Not a perfect capital guarantee, but a 35% capital guarantee, which, like I said, is at least as strong as we've gotten you well through 2008, 2009. Okay. If, however, you get below that point, you will lose like the market lost. So below 35%, the market has 36% down, you lose 36%. But at 35%, you get your money back. 34%, you get your money back. And at 1% up for the worst performing one, you get your money back plus 14% for each year. So which one is best for you? So let's look at each one. What's important? Let's go to that. Firstly, the minimums. Okay, look, not everyone can afford 250,000. Not everyone wants to put 250,000 into a particular structure. If you can't do the 250,000, unfortunately, you're stuck with just looking at the first one. If you can afford to, you can do either one. So the minimum is obviously a restriction. The next thing is offshore transfers. The second one requires an offshore transfer. So you need to be able to do an offshore transfer for you. Use your allowance for the year. If you don't have a tax clear, the certificate, if you have some issues around that there, we won't be able to do the second one for you. Okay. But quite frankly, unless you are operating, quite unethically, which case we wouldn't deal with you anyway. We're not in the business of dealing with, crooks and criminals or whatever. We are more than willing to help you, basically, even if you use your $1 million offshore transfer to get a tax clearance to get for the transfer done for you. Okay, so we can work around that, but that is obviously a thing. If you don't want to be using a $1 million allowance, something that might be a question. Now here comes the real differentiators. First, the risk outlook. In the first one, if you look at it, what it gives you is perfect protection on the downside, unlimited upside. This is when you don't know at all. You're just very uncertain about the world. You think the world might be much, much more negative going forward. Or possibly we could have a rebound coming through because central banks come in and there's basically pump money into the system. You really, don't know for certain. So in this particular environment, you get 100% capital guarantee. You get all your money guaranteed in rounds. At the same time, if the market goes up, you don't lose out on any upside. But you get twice the upside. Okay, so if you are really looking at like a very bad situation, the market might go down because whatever, but there's a very strong chance the central banks will step in and give us another, bailout because they'll fold under the pressure. This is the one for you. Okay. This is almost like you are looking at a level of uncertainty that's bigger than, say, for instance, 2008. The next one is you're looking at a more stable, more static kind of one. Yes, things are not looking great. Things are looking great, but we're not going to go through a massive crash, and not least of a massive crash, but it's way worse than 2008. In that scenario, the second one was what you want. Why? Because what it does is it gives you the best payout in a pretty stagnant economy. As long as these things basically end up flat, all at the same time on an anniversary date, we're in 9 of them over the next 5 years. On one of those dates, these 3 are basically flat. You get paid out well above inflation return. If inflation basically doesn't go to 20% or something. And you basically also don't run a risk of losing your money, because unless the market falls by way more than in 2008, your money should be capital protected as well, because of the way we built it. Okay, so here's, you think that things might be bad, but you don't think they are going to be crazy bad. Okay, so that's what the second one is for. Okay, the next is your currency forecast. The question here is, what happens if one is negative and the other 2 are positive at the end of the 5 period? You get your money back. Okay, all 3 at one of these 9 days must be positive together. 3 together, positive on the day, money back. Okay, plus investment, plus the interest, interest return of 40% a year. If on none of the days when they were positive, you get your dollars back. That is the risk here. Like I said, if we are looking at a period of a pretty stagnant economy, there's a pretty good chance you can have on 9 particular periods, especially the market kind of drifts a little higher at one of those periods, that you'll get like that little payout coming through. But if another period is all 3 are positive, and then all those periods, at least one was negative, and at the end of that 5-year period, one is still negative, is down like 1% or down anything less than 35%, you just get your money back in US dollars. Okay, so you can see that is a less risky in terms of the global view option here. Okay, because if the market was going to go through, for instance, either massive upside, let's just say we're going to do like a 70% return, okay, in the market in the next, say, 2-3 years, this won't pay out as well. It'll give you your 40% at some point in time, and you basically get kicked out in the year 1 or year 2. Okay, if the market does, like, say 70% the next year, you'll be better off buying the other one, right? But it's unlikely the market will do 70%. The market might just say 25%. Okay, then you get kicked out and get your 40% return. But at the same time, the market could be doing another 20% down from here. I saw a survey recently that most people believe that the bottom isn't in the market yet, and that we could expect it to be between a 15 and a 25% drop from here. Okay, that would mean that basically in 2 years' time, when markets recover to where they are right now, 3 years or 4 years' time, the market may have been flat for the 3 or 4 year period, but you're walking away from 14% per year. Okay. At the same time, if you look at what people are expecting, no one's expecting the market to be down more than 35%, basically 5 years from now. They're expecting a fall, but they aren't expecting, another 40% fall for a year, because markets are already down. Okay. So the currency outlook. In the first one, you're more balanced between rands and dollars. The second one, you're much more focused on dollars. The second one is more of a dollar positive thing. So if you're looking at the dollar as being your preferred currency going forward, the second one. If you're kind of iffy between rand and dollar, the first one. Okay. So that is the main considerations here. Firstly, minimums and offshore transfers. That's just a technical thing in terms of what you're looking at. But in terms of your outlook, the first one is for somebody that has a lot of volatility in the future. The second one is for somebody that basically has a reasonable level of volatility, but not beyond what we saw, for instance, in 2008. Okay, and not much more beyond that. Even 2008 would have been fine. Okay. The first one, even 2008, basically, much worse than that could be, acceptable there. The next bit is, what is your currency forecast? You think the rand's going to get stronger? Go for the first one. You think the dollar's going to get stronger, guaranteed? Go for the second one. Kind of maybe either way. The first one probably is your answer. And now looking, you can do both. The first one has a minimum of 50,000, the second one has a minimum of 250,000 pounds. You can have money in South Africa, you can have money basically overseas. We can do the second one for you guys, no problem. We will do the offshore transfer, we'll create the account for you, we'll do everything that's required to make that sure this thing is open. Okay. So if you have any questions, what you can do is now you can just give me a thing in a Q&A, and then we'll basically answer anything any questions you might have on what's been discussed so far. Anyone have any questions, any queries about what we discussed so far? Okay, so yeah, in terms of our currency outlook going forward, sorry. Okay. So let me beat this down. Okay. So basically, question here: what do you predict, or what would you prefer going forward? Look, I'm not so certain about what the world looks like in the future, but what I would like to do is that if I was the average client we have coming through, someone with a South African RA, somebody with South African investments, a South African property, a South African career, and have not done a significant amount of offshore investing at the moment. The second one is a great thing to have. Why? It gives you, firstly, the offshore account that you can use going forward. Okay. Second thing is it gives you exposure in dollars that's not linked in any strong way to South Africa. Okay. It's going to be an offshore bank guaranteeing it. It's going to be an offshore account holding it. It's going to be invested in investments that are very little South Africa exposure. So unless you already have, a significant offshore exposure, the second one is the way to go. If you are pretty balanced here between the two, it comes down to what your risk profile looks like. What do I think is going to happen going forward? I'm a bit of a pessimist. You guys know that I'm a pessimist. I do suspect that we are seeing, sorry. Okay. I do think that there's going to be a high level of uncertainty. Unfortunately, that uncertainty can be more focused in Africa than elsewhere. But South Africa has been very stable through previous crises. Even 2008, we did very well compared to the rest of the world. So if you had to ask my opinion, if you basically have pre-balance here, I would try and do both. Okay. I would like to do the local one. Okay. Because I think the local one is giving you unlimited upside if things go crazy. But if I'm a bit nervous, I'm a bit more cautious, I do the second. Okay. I'm pessimistic at the moment. I would, if I could afford to, do the second one versus the first, but I don't see any reason why we can't do both if you have money available. Okay. Okay, the question is, the pair profile slide for the auto call. The auto call trigger here is 100. So basically, as long as the as long as these three indices here are basically from the point at which we do them, flat or positive on those on any one of those 9 anniversary dates, that is the trigger. That is what gets you paid out. Okay, so that is basically the trigger of the auto call trigger. We aren't looking at a declining auto call trigger. We aren't looking at a rising one. We're just saying, looking at what the world looks like right now, these particular 3 strong indices in very strong parts of the world, despite the kind of conditions we have right now, where tech's under pressure, the euro is under pressure, and the Nikkei is, the Japanese under pressure, we think that these are pretty strong markets. All we need for them is basically in some time, next basically 5 years, to be flat. That was true in 2008. It was true basically quite a few times since then. So we've had periods where the Euro Stoxx has come down, with periods where the Nikkei has come down. but they usually come down from massive, massive spikes. We are not seeing that right now. We've really seen them fall quite significantly from the highs. We have not seen a massive spike up that is any danger to us, I think, as an investor. And the only one of these things that has actually had a massive spike is basically the NASDAQ. But again, the NASDAQ is down the most of all these indices in terms of its performance. Okay, so yes, the NASDAQ has spiked up, but it's come down quite significantly. The Nikkei, the unit stocks, not really spiked up that much, and therefore I think it's a reasonable expectation that there won't be like a 5-year bear market from them, where they're going to be 20% down or whatever over 5 years. Any other questions? Okay, another one. Sorry. Okay. The second one basically doesn't have upside. Basically, the second one gets a fixed return. Not upside, get a fixed return. Depending on what the market looks like at the moment. Sorry, this guy was just taking something away from the desk. So depending on what the market looks like at the moment, when we do the trade, we're looking maybe right now, like if I did it today, I'd be getting 15%. 15.1%, I think, is the return today. In say 2 weeks' time, when we close these things down, and then we have another 20 days afterwards to do the trade, actually, we could be seeing anything maybe 16%. We could see down to as low as 14%. Whatever that number is going to be the cap. As long as these three things are flat positive, that's the amount you'll get every year. So if it's basically, say, 15% after 1 year, you get 15% after 2 years, 30, after 3 years, 45. That's 15% simple return per year. That's kind of the cap, okay? But the cap is pretty high. Like I said, it's significantly more than the dollar return right now. Inflation rate right now. This is a US dollar return. So in real dollar terms, it's going to be basically 7%, 6% in US dollars real return. Very comparable to what the S&P 500 does historically. And maybe a bit more than that, especially if you look at what the dollar return expectations are for the next 5 years. Markets are expecting like much more than 5% US dollar inflation for the next 5 years. Okay, that means that if there's like a 5% dollar inflation, you're getting like a 9% annual return, real return, which is a reasonable level to be at. Okay, anything else? Okay, let me just go through one last thing before you guys go. I'm going to show you basically the process to open an account at Grand Swiss. Click on this link. This is the FICA we need. This is for the local portfolio. And we'll do the risk assessment, do the whole thing for you, and then we'll have the account open quite soon as the local one. For the offshore one, there's a slightly different process. What I suggest you do is give us a call. Okay. You have my details. You have in your invites. Go to our website. There'll be details. Give me a call. Say I want to do the offshore investments. What's required? There's a separate form you fill in. There's a couple extra steps you jump through. The reason for this is quite simple. I don't know if you know that we in South Africa treated by the rest of the world as being slightly dodgy. Okay, we are on the verge of being grey listed. I don't know if you know that what that means. Basically, it means that we are considered by the rest of the world to be a grey kind of area. We're not perfectly clean when it comes to our money and so on. And so international institutions, especially reputable ones, take a little more time to look at our investments and so on. That's the unfortunate part. The fortunate part is that we at Grand Swiss have opened a number of these accounts, and we are quite good at doing it. So if you basically want to do the offshore stuff, give us a call. We'll walk you through the process. We'll have somebody contact you. We'll do the questionnaires. We'll walk you through what the FICA we need. We'll open it up for you quite simply, but that requires probably a more bespoke process than just looking at this online platform. Okay, so that's us at the moment. Okay. Again, give us a call if you have any questions. You have my numbers, the emails I've sent you. Just send you emails, and I'm more than happy to talk to you guys about any particular questions you have, either about this particular topic or any of the other things we do at Grand Swiss. Cheers.